everyone, and welcome to the very first Mooney Talks Money. Today, we're going to be discussing the volatile interest rate environment, some economic indicators the Federal Reserve is going to be closely watching and making those decisions, and the resurgence of the 60-40 strategy in today's market environment. All right, first, let's talk about the changes kind of going on within the interest rate environment and some of the volatility that we've seen. I'm going to go ahead and share my screen with you. The CME Federal Reserve Watch tool, which gives us an indication of what the interest rate hikes are going to be looking like here over the next month or here in the short term. Right, and as you can see that over the last year or so, the Federal Reserve has raised interest rates by about 500 basis points, or a total 5%. And as of our last meeting in June, right, if you guys are aware that we paused rates or did not raise rates in the Federal Reserve June meeting. As of that date, there was about a 50% chance that they were thinking that they were going to have to raise rates in July, right, as seen on this 1 month chart or 5 days into June, right? If we fast forward to today, we now show there's an 88% chance that the Federal Reserve is going to raise rates again here in July. Now, these statistics change daily, and the Federal Reserve is going to be closely looking at a couple economic indicators that are going to help kind of solidify what this picture is going to look like here over the next month or so, which brings us to some economic statistics I want to share with you. The first statistic that the Federal Reserve is going to be watching very, very closely is the CPI report. Now you can see here there's two different plot charts, one including CPI that includes food and energy prices, and one that is CPI excluding food and energy prices, right? The blue line includes those prices, the maroon or red line does not, right? As you can see, there's been a pretty sharp decline if we include those inflation measures on food and energy. We're almost half of where we were this time last May in terms of year-over-year percent increases to inflation. Now, it's more of a steady decrease on the core inflation side of things. We would like to see that a little bit steeper, which is kind of why the Federal Reserve is in a position on, hey, we're pausing rates, but we're not quite sure if we're going to have to raise them or not here moving forward. So the CPI report is going to be one of those statistics that the Federal Reserve is going to be watching closely. The second one is the labor market, right, and unemployment, right? So the Federal Reserve defines full employment as 95% of those willing and able to work having jobs, right? So essentially, if there's 5% or less of unemployed people out there, right, the Federal Reserve considers that to be full employment, right? Well, all of 2022 and so far in 2023, we've been at a full employment numbers, right? And quite frankly, pretty well below those unemployment numbers. So this is the statistic we're going to keep our eyes on as well. Considering the Federal Reserve has said they're willing to hurt the unemployment rate numbers a little bit if it's going to help with the CPI and inflation data readings. So the Federal Reserve will be looking at those inflation numbers or CPI hand in hand with these unemployment numbers as they make their decisions here moving forward. So with that, I just wanted to give kind of a market breadth on what's kind of happened so far this year in the markets and kind of what we see moving forward. And one piece in particular that I want to touch base on is the resurgence of the 60-40 strategy, or the 60-40 balance strategy. And for those of you who are unaware, 60-40 means 60% equities, 40% fixed income or interest-bearing accounts or bonds or municipal bonds, whatever type of account you're looking for, the fixed income portion is that 40%. And ultimately, why we may have heard that last year that strategy was dead. Well, we're in a much different market environment than where we were this time last year, right? Last year's environment, both equity markets and fixed income markets took a pretty big hit last year. And historically speaking, that typically doesn't happen at the same time, right? If equity markets are going up, bonds are doing just okay, clipping off coupons. But if equity markets go down, typically bond environments start to do positive or have an inverse relationship. Well, last year with the rising interest rate environment, that didn't happen, right? So we were entering in a recessionary environment, equity markets were losing, and interest rates were going up, decreasing the price of the bonds that you were invested in, right? So there was kind of a double whammy in that strategy last year. Well, turn it around 12 months later, we kind of see it as a as a positive inclination to the portfolio, right? 60% of it allocated in equities, 40% in fixed income, right? Similar to that interest rate conversation, we think we're nearing the end or at the end of those interest rate hikes that the Federal Reserve's been doing the last 12 to 18 months, right? So we see them starting, as they go the other way or stop raising rates or start to cut rates, we'll see reduced or we'll see more price appreciation in some of those bond strategies. So it's truly more of an inversely related investment structure as opposed to where we were in the market environment of last year. So that wraps it up for the first ever Mooney Talks Money, and that was just a little bit of an update on opportunities with the volatile interest rate environment and kind of what we're seeing on the inflation data report side of things. Thanks.